We would prefer to have fewer customers, but who each spend more. That's not a disgruntled gambler. In 2024, it's Caesars CEO Tom Reeg admitting the Strip's strategy behind empty tables, record-high resort fees, and vanishing midweek buzz. Caesars Las Vegas is bleeding revenue, facing massive debt, and just got kicked out of the S&P 500. Is Vegas collapsing by design? And what happens when the city tells its middle class, no more Riff Raff? Tom Reeg, CEO of Caesars Entertainment, didn't mince words when he addressed investors in the summer of 2024. We would prefer to have fewer customers, but who each spend more. The message was as clear as the empty blackjack tables on a Tuesday afternoon. This wasn't a slip or a moment of frustration. It was a carefully stated strategy. For decades, Las Vegas thrived on volume. Thousands of everyday travelers filling rooms, buffets, and gaming pits. They came for affordable thrills, accessible tables, and the feeling that anyone could be a winner for a weekend. But that model, Reeg argued, no longer fit the new economics of the Strip. After the pandemic, pressure mounted on every line of the profit sheet. Labor shortages forced casinos to close off pits and cut back on service. Operating costs jumped and margins shrank. Instead of chasing crowds, executives like Reeg looked for ways to do more with less. The answer? Raise prices, shrink the perks, and focus on guests who wouldn't blink at a $55 resort fee or a $100 minimum at the tables. Staffing has not come back to pre-pandemic levels, Reeg told analysts, justifying the decision to keep fewer tables open and push up minimums. We're optimizing for margin, not for headcount. The pivot wasn't just about labor. Caesars' own financials told the story. Las Vegas revenue down nearly 4% year-on-year in the second quarter, net income off by 21%, and a stock price that had lost half its value in 2 years. The company's debt hovered around $12.3 billion, and its removal from the S&P 500 sent a new wave of selling through its shares. Reeg and his team faced mounting pressure from lenders and investors to preserve what profit remained. The calculus was simple: fewer guests, higher spending, better margins per head. In practice, that meant cutting comp rooms, hiking fees, and focusing on the so-called quality customer, the high roller, the convention whale, the big spending tourist who could fill the gap left by the missing masses. This strategy wasn't unique to Caesars. Across the Strip, operators followed the same playbook, raising prices and narrowing the door. But Reeg's public admission put the philosophy in black and white. The era of the people's casino, cheap buffets, $5 blackjack, and free parking was over. In its place, a new Vegas, thinner crowds, stricter doors, and a bottom line that depended on squeezing more from fewer. The result would soon become visible on every bill, every table, every empty seat. The specifics of those changes, the new costs, and the shrinking value would be impossible to ignore. A single night at a so-called value property on the Strip now comes with a resort fee of $50 to $55, sometimes more than the base room rate itself. 3 nights at a mid-tier Caesars hotel, once advertised for $135 a night, can balloon to $200 a night after fees, taxes, and parking. The bill doesn't stop there. Self-parking, which was free for decades, now runs $20 to $25 per day at Caesars and MGM properties. Valet can top $40. Even guests staying at the hotel aren't spared. Unless they hold elite status or gamble heavily, every car pays. The sticker shock extends to the casino floor. Table minimums that hovered at $5 or $10 for years now rarely dip below $25, even on a Tuesday afternoon. On weekends or during big events, minimums hit $100 or more, pricing out casual players and forcing many to the sidelines. Pit managers use real-time data to adjust limits hour by hour, squeezing extra dollars from what's left of the crowd. At flagship properties, A blackjack session often starts at $300 just to sit down after 6 p.m. For many, the thrill of Vegas now begins with a math problem. For travelers browsing online, the frustration sets in just before checkout. Industry studies show that when resort fees and mandatory charges finally appear, more than 30% of potential guests abandon their booking. This isn't just a Vegas problem, but the Strip amplifies it. Viral posts of $250 nightly totals for basic rooms, or receipts where fees outweigh the room rate, have become a rallying cry. Booking platforms and consumer lawsuits document the same trend. Hidden fees and last-minute charges drive away the very visitors the city once counted on. The cost spiral doesn't end at the tables or the front desk. Food and beverage prices have climbed too, with a simple breakfast topping $25 in many hotel cafes. For a typical 3-day trip, the out-of-pocket total now lands between $1,400 and $1,750, nearly double the advertised estimate. For many middle-class families and longtime regulars, the math no longer works. Instead of a spontaneous getaway, a Vegas trip now requires careful budgeting, and often a second look at the cancellation button. The result is visible in the numbers: fewer bookings, shorter stays, and a growing sense that the Strip is no longer for everyone. As costs rise and value erodes, the volume engine that built modern Las Vegas sputters. The friction is no accident. It is the outcome of a deliberate strategy, and the consequences are rippling through every corner of the city. Caesars' balance sheet tells the story behind the thinning crowds and rising prices. In the second quarter of 2025, Las Vegas revenue at Caesars dropped by 3.7% compared to the year before, down to just over $1.05 billion. Net income fell even faster, tumbling 21% in a single year. Occupancy, once near perfect, slipped by 2 percentage points. That meant nearly 27,000 room nights went unsold, a loss that rippled through every part of the business. These aren't just numbers. They are the financial shockwaves of a premium strategy colliding with softer demand. The company's debt load remains massive. As of mid-2025, Caesars carried about $12.3 billion in long-term debt, a figure that dwarfs its annual profits. Asset sales, like the World Series of Poker brand and the Linky Promenade, brought in some cash but didn't solve the underlying problem. Even after redeeming $546 million in senior notes that July, the overall burden barely moved. Analysts at Barclays and JP Morgan flagged the risk. If Las Vegas softness continues, Caesars could run up against its loan covenants, rules that, if broken, would force even deeper cuts or fire sales. Then came the blow that shook investor confidence. In September, Caesars was removed from the S&P 500 index. For a company of this size, index membership isn't just a badge of prestige, it's a lifeline. Index funds and ETFs, which together owned up to 18% of Caesars' float, were forced to sell millions of shares within days. Trading volume spiked to more than 3 times normal, and the stock price dropped another 5 to 8% almost overnight. For a company already down 30% for the year, and 50% over 2 years, this was a dangerous spiral. Losing S&P 500 status also made it harder and more expensive for Caesars to borrow. Credit rating agencies issued warnings, and the cost of new debt jumped by up to 0.7 percentage points. That means every dollar borrowed to refinance or upgrade a property now costs more, eating into already thin margins. Internally, the finance team responded by slashing costs and deferring upgrades. Emergency meetings focused on keeping enough cash on hand to avoid tripping the next set of lender rules. The effects reach the casino floor. Deferred maintenance and delayed property refreshes mean that amenities stay outdated longer. Marketing budgets shrink, so fewer comp rooms and promotions go out to fill slow nights. Staff cuts become unavoidable, especially outside of peak weekends and conventions. The guest experience, once a point of pride, quietly erodes as the company fights to keep its financial head above water. The logic behind the premium strategy was simple: fewer guests, higher spend, better margins. But the numbers now show what happens when that bet doesn't pay off. With revenue down, debt still towering, and the safety net of index inclusion gone, Caesars faces a financial squeeze that no amount of fee hikes can fully offset. The company's struggle is no longer just a boardroom debate. It's a daily reality for every guest, employee, and investor tied to the Strip. The Strip's missing crowds didn't just vanish. They found new places to play. As Caesars and its rivals pushed up prices, gamblers and tourists began voting with their wallets. Regional casinos outside Las Vegas reported a surge in business. Laughlin, an old river town 2 hours south, posted a 17% jump in gaming revenue year over year. Mesquite, once a sleepy desert outpost, saw its own take rise by nearly 10%. These aren't just statistical blips. For every empty seat on the Strip, a slot machine in Laughlin or Mesquite filled up with a former Vegas regular. Locals' properties across the Las Vegas Valley, like Red Rock and Boyd Gaming's portfolio, grew their market share. They didn't just benefit from geography. Their playbooks offered what the Strip no longer did: free parking, lower table minimums, and generous comps for everyday players. Billboards along the 215 Beltway promised return to value and no resort fees, directly courting the disillusioned. Loyalty signups at these off-strip casinos climbed sharply, and slot handle, the total amount wagered, hit record highs for several quarters in a row. But the biggest shift played out online. Nevada-licensed internet casinos and sports betting platforms pulled in $1.78 billion in revenue by July 2025, up 20% from the previous year. Many of these new players weren't digital natives. They were the same 35 to 65-year-olds who once made annual pilgrimages to Las Vegas. Now, facing $55 resort fees and $100 blackjack tables, they logged in from home. Operators reported a surge in first-time deposits from California, Canada, and other feeder markets. For these customers, the appeal was simple: no parking fees, no hidden charges, no waiting for a seat. The numbers made it clear. While the Strip's gaming revenue fell by about 4% in the first half of 2025, regional and digital competitors picked up the slack. The volume engine that once powered Las Vegas had been rerouted. Even taxi and rideshare drivers noticed the change. Airport queues for Strip runs thinned out midweek, while more fares headed to locals' casinos or left town altogether. The Strip's transformation into a premium destination didn't erase demand. It redirected it. Every percentage point lost in Vegas became a gain for Laughlin, Mesquite, or an online betting app. The economic leakage wasn't limited to gaming. Ancillary spending, meals, shows, retail followed the gamblers. Locals' casinos reported busier restaurants and higher bar tabs. Online platforms rolled out loyalty perks and bonus credits, further cementing new habits. For the first time in decades, the Strip's grip on Nevada's gambling dollar loosened, and the old formula, draw a crowd, keep them spending, was being rewritten elsewhere. The consequences would soon be felt not just in boardrooms, but in the lives of those who once depended on Strip volume for their livelihood. A weekday morning on the Strip now begins in silence. Dealers arrive to find 3 or 4 shifts posted for the week, down from the steady 5 they counted on before. My table minimum went from $10 to $25, but we still sit empty, one dealer says, glancing at a pit where half the seats are roped off until Friday. The casino's volume model once meant constant rotation and full shifts. Now, midweek hours are a gamble in themselves, with staff waiting for a surge that rarely comes. Bartenders feel the pain in their pockets. A veteran at a center bar stacks receipts, each one smaller than last year's. Weeknights I bring home about half what I used to, she explains, tip jar barely touched by closing time. The energy that once spilled from the bar to the floor now flickers out early, replaced by slow nights and careful budgeting. Rideshare drivers circle the airport, checking their phones for Strip fares that don't arrive. Two-day city, Sunday night surge, then crickets, a cabbie mutters. The pattern is clear. Weekends still draw crowds, but weekdays leave drivers idling for hours, watching as more passengers head to locals' casinos or bypass the city altogether. At a dealer school north of Sahara, enrollment boards show a 30% drop from last year. The director flips through applications, many weeks coming up empty. Placements have dried up, now matching pandemic lows, she says. With Strip properties cutting new hires and relying on flexible staffing, the pipeline for new workers shrinks, and the promise of a steady casino job fades. These aren't just isolated stories. They are the human cost of a city re-engineered for fewer, bigger spenders. For thousands of workers, the old Vegas dream, steady work, good tips, a shot at something better, has slipped further out of reach. In early 2025, Resorts World Las Vegas made a bold move. Management scrapped resort fees and brought back free parking, two friction points that had driven guests to reconsider their Strip plans. The decision ran against the prevailing wisdom of the industry, which insisted that high fees and premium pricing were the only way to keep margins alive. Within months, the numbers told a different story. Occupancy climbed by 4.5 percentage points, even as average daily rates held steady. Gaming revenue at the property jumped 8.1% over the following 6 months, outpacing the broader Strip, which continued to struggle with declining volumes. Convention bookings, a critical piece of midweek business, rose by 10% in May, according to data from the Las Vegas Convention and Visitors Authority. The response from guests was immediate. Direct booking channels lit up with positive feedback, and social media buzzed with posts celebrating the return of value. Many cited the elimination of surprise charges as the main reason for choosing Resorts World over other properties. Convention planners, long frustrated by unpredictable costs, shifted events to the property, filling rooms and casino floors on traditionally slow days. The experiment caught the attention of operators and analysts alike. The gains at Resorts World suggested that the old Vegas lever, removing barriers to entry, still worked. As the rest of the Strip debated whether to double down on exclusivity or open the doors once more, the evidence from Resorts World offered a simple question. If value can drive volume here, what's stopping the rest from following suit? In 2024, Caesars Las Vegas revenues fell by 3.7%, and occupancy dropped by 2 points, removing the company from the S&P 500, clear evidence of the costs behind the premium-first strategy. Internal documents and CEO Tom Reeg's public statements confirm a deliberate pivot: fewer guests, higher spending, and rising fees. As resort fees hit $55, parking reached $25, and table minimums climbed to $100 or more, over 30% of online bookings were abandoned when true costs became visible. The fallout is measurable. Dealers and bartenders lost shifts and tips, while regional casinos and online platforms posted double-digit gains. Still, it remains unclear how far Caesars and the Strip will go to reverse these changes, or if they can fully recover lost volume. Today, the evidence shows that pushing out the middle class has triggered both financial and human consequences. Whether Las Vegas can restore its soul or will remain a city for the few is a question only future data will answer.